Go to deferred tax assets, okay? Page 941, deferred tax assets. I think in the year 2015, I bought a TV, a nice TV. I didn't put it up till last year, and in February of this year, lightning struck it, okay? So when I bought it in 2015, and I still don't have one, so anybody want to give me a Christmas present, I appreciate it. Let's just say I bought the warranty expense back then, even though I didn't. But let's just say I did, okay? And if it were eligible, or not eligible, if it was still able to be done this year, whatever, when it happened, then that would have counted against 2015 revenue for Walmart. Yeah, for Walmart. It was a company for Walmart, okay? Now, when they recorded warranty expense in their income statement, did they really and truly incur an expense of buying new TVs for me at that point in time? No, there was no TV. They didn't know that anything was going to happen to mine, okay? But it still said revenues minus expenses minus warranty expense equals income, because you had to keep it in there. That was not a cash outlay. All right, let's look at that in terms of this right here. Down at the bottom of page 941, we see RDP Networking reported pre-tax income. I'm just going to use 1 year in 2016. Okay, of $70 million. That's what we have there. Pre-tax, once again, is revenues minus expenses. So let's say my TV costs $700, which it didn't, because I got deals. Okay, so say it costs $700. But what you have here was the warranty expense to Walmart. Walmart got that $700, and they also got that $300. Okay, if they did not use the warranty expense, then they would have had how much income? They would have shown how much income? Revenues minus 30 equals 70, so put that 30 back in, they would have shown income of how much? 100. So that's how you come up with this taxable income of 100 right here. Does that make sense? And does it make sense why? The why part is because, well, it was an expense. We had to keep up with it in that year, but we did not include any income. The fact that it's in there means that, hey, I'm going to have taxable income of $100,000. Now, that's more than my book income, right? So I'm going to pay taxes on 100. I'm not going to pay it on 70. But in the future, as we see in 17 and 18, we're going to have half our people, we expect to have half our people come in and redeem their warranty. We expect to have half later. That's going to do what? Change in the future. When those things change in the future, we call that a temporary difference that reverses. And that's what they call temporary. In the future, they're going to be settled, okay? As opposed to permanent. We'll talk about that in a second. Would it be right for me to have to go ahead and pay taxes later or have a tax effect later on? No, because I already paid it now. So if I pay taxes now, and it's going to cause my income to be lower in the future, then I've created what you call an asset. An asset, remember, the standard definition is basically a probable future economic benefit. It's probable that these people are going to come in based on history and they're going to redeem it. So I have a deferred tax asset. I won't have to pay taxes on the $30 million that's coming up. That's how to create deferred tax assets. When my taxable income is higher, I pay more now, and in the future, I don't have to pay as much. Okay, deferred tax assets. And when you flip over, we use the same process. Even before we flip over, we can see here, we'll use the same process. We have a income tax rate of 40 million. So taxable income taxes payable is 100,000 times what? Times the 40%. That'll be my income taxes payable. Right at the bottom. That's how we got $40 million. Okay. I have 30 million and my income tax rate is going to continue to be I have $30 million. My income tax rate will continue to be 40. So 40 million times 30 is going to give me 12 million. In this case, notice I debited deferred tax asset because when I increase any asset, I increase it through a debit. Make sense? Okay. So that's what's going on. And just as before, your income tax expense is always going to be the sum of what you have. In this case, the sum will be the difference, which is 40 minus 12 will give you 28 million. So you have to get your income taxes payable and you have to get your deferred tax item, be it asset or liability, and then you can actually get what you're looking for in terms of income tax expense. Yes, sir.
This doesn't pertain to this, but you were talking about the Walmart with the TV and the warranty, and they have to keep up with it like if it was like a 2-year warranty. So like car dealerships, they have like 10-year warranty. They have to keep up with that stuff for that one.
Right. And actually, I'm glad you brought that up because that kind of goes as we're talking about revenue in our revenue chapter. The basic manufacturer's warranty, if that's a manufacturer's warranty for 10 years, which I think it is in some cases, that's one thing that comes with the car. But what if I buy an extended warranty of 200,000? What do I treat that as? So, a separate performance obligation. So make sure that when we're talking about warranties, and this is not applicable so much to this chapter as it is just kind of tying in things, my regular quality assurance type warranty, make sure nothing goes wrong, usually with the motor. It's not going to replace stuff you think, but with the motor, generally is what it is. That's a quality assurance. Whereas with the extended warranty, totally separate performance obligation, and you have to sign something to that. So everybody make sure when we're tying in things that that's one of the things we do. Yes, sir.
If the company, all right, so say like I have a warranty on my truck and the alternator goes out or whatever, and that's under warranty, so they replace the alternator. Well, there's related labor expense to that, and they usually pay for that as well. Do they have to keep up with that? Like, you see what I'm saying? Is that like built into that?
Yeah, I mean, if alternator go bad, we know it's going to, I don't know what kind of vehicle you have, but in mine, I can tell you, it costs about $300. Okay, so you're going to have that plus whatever labor you have, maybe about $100 and $150. And that's, so especially if it's one of those things where they have these recalls and stuff, I believe that they've already known, they have already known that something is going to go wrong. They've already calculated that cost. You see what I'm saying? Which includes that. So that's a part of it. So that 30 million, let's say $300 warranty that I had, let's just say it was a quality assurance. They already know that maybe the LCD is going to go out and maybe it costs $300 plus labor and all that. That's what they've already estimated. They've taken all that into account. Okay. If you couldn't quantify it, you might not even have a certain, especially an extended warranty. But with quality assurance, based on history, that's what they have there. And remember, if it's an extended warranty, that's a separate performance obligation, and you need to make sure you allocate, if you have not done so, allocate a portion of your revenues to that according to your market value. Okay.
My husband used to work on tractors, and if they got a tractor that was under warranty, they had like a book, like a manual that they would go back to, and they would see exactly how much and how much time was allowed for that particular problem.
Yeah.
So like they've already got the book, so they just go back to the book.
And which means that they actually, accounted for that ahead of time. And it may have been something like, well, I can't tell you exactly, but I think I had some work done on my car on the other car, like in the year 2000 something, it's like $40 labor. No, it was more than that. And you ask, well, why? And they'll say, well, they take into account the experienced people and the inexperienced people. So even with that, that's what their quote unquote labor. Everybody not getting paid $40 or $100 an hour, but you're a mix of people, kind of what you have, and that's part of what she's saying there. So does that kind of help you out a little bit? Yeah, they take that into account. Even if it's a brand new product that you have to guess, that goes back to something that we talked about earlier. Not so much earlier in here, but in your intermediate one or in your principles of accounting, like your allowance method, you set aside so much, but you could, have a little bit more in terms of your bad debt, which creates a debit balance. So the same type of thing, which is actually leading to another conversation we'll have in here. With deferred tax assets, you also have to value those, valuation. Okay, so let's kind of lead into that there. Flip over to page 946. Okay. You have accounts receivable. What's the country account to accounts receivable? I just said it. The allowance. You have property, plant, and equipment, and you have what? Depreciation or accumulated depreciation, okay? So both of those are measures by which we value how much we're going to receive. Remember, and this is a tip from me to you. You can use it or not. I believe I passed the financial part of the CPA exam by understanding the basic definitions, and one part of that was assets. Probable future economic benefits. Okay, that's the first 4 or 5 words. It's probable that I'll realize that deferred tax asset. It's probable that I will collect all of my accounts receivable. Not guaranteed, but probable, which means that there's a portion in there that's not probable. What do? I have to go back and value that. In inventory, you have to make sure your inventory was valued correctly. Otherwise, you have to make an adjustment for that. So with any assets you have, you should go back periodically, at least once a year, but periodically is usually the term, and make sure that you're going to receive the economic benefit that you thought you would receive. In the case of the valuation allowance, if you do not expect to receive all that, then you must expense that in the current period. So the second paragraph under valuation allowance says, for example, let's say that in the previous illustration, management determines that if it's more likely than not, that's the criteria, more likely than not, underline that or underscore that. More likely than not that $3 million of the deferred tax asset will not be realized, then you reduce that by the creation of a valuation allowance. Debit income tax expense is a current period expense. Kind of what you were saying earlier. What happens if I go over? Well, in this case, you didn't so much go over. You just didn't realize everything that you thought you would. So you record that in the current period, okay? And you do that each time. Each time. Okay? So that's the complete discussion on deferred tax assets.